Picture a Saturday morning in 2000. In a strip mall somewhere in suburban America, a RadioShack store opens its doors at 9. The manager unlocks the front, flips the sign, and straightens a display of cordless phones. By noon, a steady parade of people have passed through. A father buying a remote-control car for his son's birthday, a retiree looking for a replacement antenna cable, a teenager eyeing a handheld scanner. The register keeps ringing. The company, at this moment, operates more than 7,000 locations across the United States. It is woven into the physical fabric of the country in a way very few retailers ever achieve. Its revenue is climbing toward $5 billion. Its stock is the subject of analyst upgrades. Its name is a synonym for a particular kind of American resourcefulness, the idea that if something needed fixing, RadioShack would have the part. Then comes 2015. The lights go out, not metaphorically. Literally, in store after store, the lights go out. A company that once employed more than 34,000 people files for Chapter 11 bankruptcy. Most of its locations are sold or shuttered. The others follow within months. The silence after is almost total. What happened in between those two moments is not a story about bad luck or a market that moved against an innocent company. It is a story about a company that had every advantage it needed to survive and systematically failed to use them. The origins of RadioShack run deeper than most people realize. The company was founded in Boston in 1921, originally as a supplier of amateur radio equipment. The name itself was a nautical term for the small compartment on a ship that housed radio gear. For decades, it operated as a specialist retailer, small and regional, serving the hobbyists and engineers who understood electronics when most Americans did not. The transformation came in 1963 when the Tandy Corporation, a Fort Worth leather goods company, acquired RadioShack for roughly $300,000. Under Charles Tandy, the company was rebuilt around a single insight: ordinary Americans were becoming curious about electronics, and nobody was serving them well. Department stores were indifferent. Specialty shops were intimidating. RadioShack positioned itself as the friendly middle ground: knowledgeable staff, accessible prices, stores in every town of consequence. The model worked. By the late 1970s, RadioShack was one of the most recognized retail brands in America, with locations in every state and a catalog that became, for electronics enthusiasts, what the Sears catalog had been for an earlier generation. In 1977, the company launched the TRS-80, one of the first mass-market personal computers. It sold 200,000 units in its first year. RadioShack had, at that moment, a credible claim to being the company that would bring the digital age to the American household. The culture that built this was deeply confident. Employees were trained to be genuinely helpful, to know the products, to diagnose problems, to speak the language of electronics to people who didn't. There was pride in that. The stores were not glamorous, but they were trusted. Investors rewarded the company with a valuation that, at its peak in the early 2000s, reflected real conviction that this was a durable, essential American institution. That conviction was not irrational, it was earned, which is precisely what makes what followed so instructive. By 2000, the consumer electronics landscape was beginning to reorganize around a new axis: the mobile phone. Wireless carriers were signing up millions of new subscribers every quarter. Handsets were becoming fashion items as much as tools, and the infrastructure required to sell them: knowledgeable staff, nationwide retail presence, a customer base already comfortable buying electronics, described RadioShack almost perfectly. The company recognized this. It entered into partnerships with Sprint and Verizon. It began selling phones and wireless plans alongside its traditional inventory. There was a period, in the early 2000s, when RadioShack's strategy looked reasonable on paper: use the existing footprint to capture mobile customers, keep the core electronics business stable, let the two businesses cross-subsidize each other. Inside the company, according to accounts from people who worked there during that era, there were voices arguing for something more aggressive. Not a partial pivot, but a full one. Strip out the components, the cables, the batteries, or radically reduce them and rebuild the stores around mobile. Become, in effect, a wireless carrier's best distribution partner before someone else did. Those arguments were not ignored. They were heard, weighed, and set aside. The reasoning seemed defensible at the time. The components business was still generating revenue. The customer who came in for a battery might also buy a phone. The brand equity was tied to the idea of RadioShack as a general electronics resource, the place that had everything. Narrowing the proposition felt like a risk. It felt like abandoning something that was working. What was not fully visible in those internal meetings, or not weighted heavily enough, was the rate at which working and sufficient were diverging. Best Buy was expanding aggressively, offering a wider selection at competitive prices and a shopping experience that felt more like the future. The Apple Store, which opened its first locations in 2001, was demonstrating that a focused, beautifully designed retail environment could generate extraordinary loyalty and revenue per square foot. Neither of these competitors was playing RadioShack's game. They were inventing new ones. The structural trap was this: RadioShack's success had been built on being the only serious option in a particular niche. It was the place you went because there was nowhere else to go. That advantage had quietly expired. In its place was a market with real competition, where the default choice was no longer RadioShack. It was whoever made the experience better, the price lower, or the product more compelling. The company had built its identity around availability, but availability alone was no longer a competitive advantage. The people who made the decision to hold the line on the existing model were not fools. They were experienced, data-driven executives working within a culture that had been rewarded for exactly this kind of cautious stewardship. The problem was not that they lacked intelligence. The problem was that the intelligence they applied was calibrated for a world that was in the process of disappearing. What followed was not a sudden cliff, but a long slope, steep enough to be alarming and gradual enough to encourage denial at every stage. Between 2001 and 2006, revenue held at levels that allowed optimism. The wireless business was contributing meaningfully. Management could point to the numbers and argue that the strategy was working, but beneath the surface, the margin structure was eroding. The components business, historically a high-margin anchor, was being undercut by online retailers who could offer the same resistors, cables, and adapters at a fraction of the price with no physical overhead. Amazon had been founded in 1995. By the mid-2000s, it was commoditizing exactly the kind of low-cost, high-variety inventory that RadioShack had always used to justify the trip. In 2006, RadioShack reported a net loss of $62 million, the company's first significant annual loss in decades. The board, which had been patient, was no longer patient. A new CEO, Julian Day, was brought in with a mandate to cut costs and stabilize the business. Day oversaw the closure of more than 400 stores and a significant reduction in corporate overhead. The stock recovered somewhat. The crisis, it appeared, had been managed. What the recovery obscured was that cost-cutting is not a strategy. It is a pause. RadioShack had reduced its losses without addressing the reason for those losses. The customer who had stopped coming in was not going to come back because the company was leaner. The competitor who had taken that customer was not going to cede them back out of courtesy. Between 2006 and 2011, a succession of management teams attempted variations on the same theme: find a new anchor product, renegotiate the carrier relationships, experiment with store formats. There were attempts to push into gaming, attempts to capture the do-it-yourself electronics market that was growing around microcontrollers and maker culture, a segment that RadioShack, with its history, should have owned, but never fully committed to. There were rebranding efforts, advertising campaigns, and a notorious Super Bowl commercial in 2014 that was widely praised for its self-awareness and widely noted to have done nothing for the actual business. Through this period, the layoffs came in waves. In 2012, more than 400 corporate employees were let go. In 2013, the company attempted to close over 1,000 stores and discovered that its lease agreements, negotiated during an era of expansion, made that legally complicated and financially punishing. The stores that should have been closed stayed open, bleeding cash they could no longer afford to bleed. Executive departures accelerated. Between 2012 and 2014, the company went through multiple CFOs and a CEO transition under circumstances that did not suggest an orderly succession. The institutional knowledge that remains in any large company, the unwritten understanding of how things work, who knows what, which relationships matter, was dissolving. Revenue in fiscal year 2013 fell to $3.4 billion, roughly half of the company's peak. The following year it fell further. Analysts who had once written upgrades were now writing obituaries. On February 5, 2015, RadioShack Corporation filed for Chapter 11 bankruptcy protection. The company listed assets of $1.2 billion against liabilities of $1.4 billion. It was the second largest retail bankruptcy of that year. Standard General, a hedge fund, acquired approximately 1,700 of the remaining locations in a deal that also involved Sprint taking floor space within those stores. The rest, more than 1,000 locations, were simply closed. The final day of normal operations at most stores was unremarkable. Employees showed up, ran transactions, answered questions. A few customers, learning the news from their phones or the local paper, came in to say something to a store associate they had known for years, to a place they had come as children. Most days ended quietly. Registers were counted. Keys were handed in. The human accounting was significant. Roughly 25,000 employees lost their jobs in the initial bankruptcy filing, with thousands more to follow as the acquired stores were restructured. Many of these were people who had spent significant portions of their careers with the company, store managers in their 40s and 50s, corporate staff who had turned down other opportunities, technicians who had trained generations of junior employees. They did not lose their jobs because they had done anything wrong. They lost them because the organization around them had failed to adapt over a period of roughly 15 years. Investors absorbed losses across the shareholder base. Pension funds that had held the stock as part of diversified portfolios wrote down positions. Vendors who had extended credit were left with outstanding balances they would not recover. The brand itself was sold in the bankruptcy proceedings and has changed hands since. It exists today in a reduced form, primarily as an online retailer, carrying a name that still holds recognition with people who remember what it once was. The lesson that RadioShack's story tends to generate is the same one that gets applied to Kodak, Blockbuster, and a dozen other companies from that era. They failed to innovate, they ignored disruption, they were too comfortable to change. This reading is not wrong, exactly, but it is incomplete in a way that makes it useless. The more precise lesson is about the relationship between competence and survival, and why high competence in a particular domain can actively prevent the recognition that the domain itself is expiring. RadioShack was genuinely good at what it did. Its staff were knowledgeable. Its supply chain was efficient. Its real estate footprint was enviable. Its relationships with carriers were real and valuable. None of this was in question. The problem was that the skills required to manage an existing business successfully are categorically different from the skills required to identify when that business needs to become something else. And organizations that have been rewarded consistently for the former tend to structurally undervalue the latter. The people who argued for aggressive transformation inside RadioShack were not rewarded by the culture for that position. They were managed, negotiated with, and ultimately overruled by people who had the authority that came from having been right before. Past success is not just an asset in this dynamic, it is also a form of argument. "This is how we built what we have" is a powerful sentence inside any organization, and it is very difficult to counter with a hypothesis about a future that hasn't arrived yet. This pattern exists in every large organization that has been successful for long enough. The company that built a market becomes, in time, a company that defends a market. The muscle memory of defense, of protecting margins, managing existing relationships, optimizing what works, gradually atrophies the muscle memory of offense. By the time the need to go on offense becomes undeniable, the organization often no longer has the capacity for it. This is not a failure of individuals. It is a failure of systems, and systems of this kind are not unique to RadioShack. The brand still exists, technically. It is owned by a company based in Fort Worth, the same city where Tandy Corporation once transformed a small Boston electronics retailer into something that touched the lives of millions of Americans. The website sells components and cables and hobbyist gear, the kinds of things RadioShack always sold. Somewhere in that reduced inventory is a trace of what the company was at its best: useful, specific, honest about what it was offering and to whom. What is gone is the physical presence, those 7,000 stores, those Saturday mornings, that particular texture of American retail life. What is gone is the institutional memory of 3 decades of people who understood electronics and understood customers and understood how to connect the two. RadioShack did not die because the world no longer needed what it offered. It died because it could not decide, clearly enough or quickly enough, what it was truly offering and to whom. And by the time that question had a definitive answer, the company no longer had the resources to act on it. That is not the story of a company that failed to see the future. It is the story of a company that saw the future clearly enough and flinched.